In 2008, a bank called Northern Rock collapsed in the United Kingdom, and for the first time in over a century, British people stood in queues outside their local branch, trying to get their money out before it was gone. The images were extraordinary. Ordinary people standing on pavements in the rain, clutching account numbers, suddenly aware of something they had never had to think about before. The money they believed was sitting safely in an account, waiting for them, belonging to them, wasn't quite there in the way they had always assumed. And the most unsettling part wasn't the queue, it was the realization, written across every face in those photographs, that they had never actually checked. Most people move through their entire financial lives without ever questioning the basic mechanics of what a bank actually does with their money. And why would they? The app works, the card works, the number on the screen goes up when you get paid and down when you spend. The system is invisible precisely because it functions, and things that function don't invite scrutiny. But that invisibility has a cost, and understanding that cost starts with a legal fact that banks have no particular interest in advertising. This video is going to take you through two things. The first is what your relationship with your bank actually is, legally, structurally, in ways that are almost entirely different from what most people assume. The second is what the digitalization of money has quietly done on top of that, and why the combination of those two things represents a vulnerability that almost no one is walking around aware of. By the end, you won't want to burn your bank card, but you will understand something about the system your financial life runs on that you almost certainly weren't taught, and that the institutions benefiting from your ignorance have never volunteered to explain. Here's why this already matters to you specifically. Every dollar, every pound, every euro you have ever deposited into a bank account has, from the moment it landed, legally stopped being yours in the way that you think it is. You didn't sign anything that told you that. Nobody called to explain it. But it is the legal and operational foundation of the entire banking system, and almost nobody knows it. When you deposit money into a bank, you are not storing it, you are lending it. The moment that transfer clears, the money becomes the bank's asset. You become an unsecured creditor, which is a legal term, meaning that if the bank fails, you join a queue of people the bank owes money to. Not at the front of that queue either. Secured creditors, bondholders, certain institutional lenders get paid first, and you get what's left. This is not a loophole. This is not a technicality buried in the small print of one particular institution. This is the foundational legal structure of banking in almost every country in the world. It has been tested in court, it has been upheld repeatedly, and it is the direct reason that bank runs happen. But it goes further than that, because banks don't even hold your money in the first place. Fractional reserve banking, the system operating in virtually every major economy, requires banks to hold only a fraction of their deposits and reserves. The rest is lent out, invested, deployed, earning the bank a return, while you assume it's sitting there somewhere with your name on it. In practice, this means that if every customer of a major bank tried to withdraw their money on the same day, the bank could not pay them all. Not because something had gone wrong, because that is how the system is designed to work. It functions on the assumption that everyone will not ask for their money at the same time, and historically, that assumption is held until it hasn't. However, most people, when confronted with this, land on the same response. The government protects me, there's a guarantee scheme, I've heard of it, I'm fine. And they're not entirely wrong. In the UK, the Financial Services Compensation Scheme protects deposits up to £85,000 per person per institution. In the US, the FDIC covers up to $250,000. These schemes are real, they have paid out, and they matter. But here is what the reassuring headline figure doesn't tell you. The FDIC Insurance Fund, the actual pool of money set aside to cover American deposits in the event of a bank failure, covers a fraction of the total insured deposits. Estimates have put it at somewhere between 1 and 2% of the deposits it is theoretically backstopping, which means that the guarantee is, in any scenario involving multiple simultaneous failures, ultimately a government promise rather than a pre-existing pot of money. That promise is credible most of the time. Governments can print money, they can intervene, and they did in 2008 when the system held. But it held because of a political decision made under extraordinary pressure in a matter of days, not because the safety net was the size people imagined when they felt safe. Just quickly, if you enjoy the videos that I make and want to see more, there's a good chance you're not subscribed. Most of you aren't. It takes 2 seconds, and it means you won't miss the next one. And that is where the first problem ends, and the second one begins. Because everything so far, the fractional reserves, the creditor status, the guarantee schemes, has been true for decades. None of it is new, and the system has survived. What is new is what digitalization has done to money itself. And this is the part that almost nobody is talking about seriously enough. For most of human history, if you didn't trust a bank, you had an exit. Physical cash, gold, something tangible you could hold that existed outside any institution. That option gave individuals a form of leverage, however small, over the system. Also, physical cash had another property that is easy to overlook until it's gone. It's anonymous. Nobody needed to approve a cash payment. Nobody could freeze it, reverse it, or attach conditions to it. Digital money does not work like that, and the shift from physical to digital has not been a neutral upgrade in convenience. It has been a fundamental restructuring of who controls your access to your own finances. Consider what happened in Canada in 2022. The government, responding to trucker protests, invoked emergency powers and froze the bank accounts of individuals associated with the protest. No court order, no criminal charge, and the accounts were frozen within days. You can have whatever view you like about the politics of that situation, but the financial mechanism it revealed was real, and it was available precisely because digital money, in the way physical cash is money, it is a number in a database maintained by an institution, accessible only through systems that can be administratively restricted. Therefore, the question of whether you trust your bank has quietly become something larger. It is now a question of whether you trust every institution that sits between you and your own financial life, the bank, the payment processor, the government, to never have a reason to use that access against you. And now, add to all of this is the infrastructure risk, because digital financial systems are by definition infrastructure, and infrastructure fails. In 2018, TSB Bank in the UK attempted a software migration and locked approximately 1.9 million customers out of their accounts for weeks. Not a hack, not a fraud, a technical migration that went wrong. People couldn't pay rent, couldn't buy food, couldn't access money that was by every legal and moral standard theirs. Although that was a contained incident, it was also a preview, because the financial system is now a network of aging legacy infrastructure, patched over decades, running services that hundreds of millions of people depend on, with no meaningful alternative, and the cyber attack risk of that system grows every year. The World Economic Forum has listed a catastrophic cyber attack on financial infrastructure as one of the highest impact global risks for several consecutive years. None of this means the system is about to collapse. It probably isn't, but the stability is not structural in the way people imagine. It is not backed by vaults and guarantees in the way imagery of banking suggests. It is, at its foundation, backed by confidence. You didn't choose to trust this system. You were born into it. The account was open for you. The card was handed to you. The app was downloaded as a matter of necessity. The trust was never really a decision. It was a default, and defaults, almost by definition, are things we never examine. However, the people running this system, they know exactly how the system works. They know about the fractional reserves, they know about the insurance fund ratios, and they know about the infrastructure vulnerabilities. And they are, not unreasonably, hoping that you don't think too hard about it. Not simultaneously, anyway.